All right. Good morning, everyone. So it's been a while. I sent a video, like I've just been tight with school and all that. But this is actually going to be a really short section just to let you know that we are still in business. So like I'm going to send a really short session. So we did an introduction and then we looked at how to use TradingView. And then I also sent a short video on how to use MT4 or MT5, depending on, like for those who would be trading exclusively on their phone, to be able to have an idea of how to be able to use just the phone. So what I'm going to talk about today is really going to be short, and we're going to talk about the various markets you can trade. Markets to trade. Markets that you can trade. So there are so many things that you can trade, but the most common one that I'm sure most of you are already familiar with it, number one is Forex. We have stocks, crypto, and then we have synthetic indices, or some call it VIX, volatility. So these are the common markets that you can trade. So we have what we call Forex, stocks, and then crypto. So we also have another category called, so we have synthetic indices and then we have indices. So I'll give examples of each. Indices. So when we talk of Forex, Forex means you are trading currencies. So the dollar, the euro, the pound, the Australian dollar, and all that. So Forex is currency trading. Stocks is buying shares. So you're buying shares of a company. So for instance, so stocks is shares of a company. So for example, you're buying shares of Facebook, Tesla, and companies like that. So that is stocks. And then we have crypto. So cryptocurrency, anytime we mention cryptocurrency, the first thing that will come to everyone's mind is what Bitcoin, right? Yeah, the next popular one is Ethereum. So what is cryptocurrency? Cryptocurrency is like a virtual money. So just like the way we have physical cash, cryptocurrency is like virtual money, like money that we can spend, which is built on the blockchain, but we cannot like see it and touch it like the way we can see money. But it's also a means of transaction that is based on technology. So that is cryptocurrency. And then we have indices. Indices can actually be anything. So indices can be created for anything. So let me give you a very important, like a very simple example. So let's say you're standing in front of your house and there is car passing. You can build an indices that says cars passing left and right. So let's say there is a graph that is connected to this. So anytime a car passes right, the graph ticks up 1. And anytime a car passes to the left side, it ticks down. So you can have an indices that record up and down ticks. So if 2 cars move to the right at the same time, there will be 2 ticks. And if 2 cars come to the right, at left-hand side, there will be a tick to the downside. So that is an indices. So this is that is an index. So you can create an index for anything at all. So when you create an index, you have what we call, you create an index. I think I'm making things more complicated. So let's stick to one. Let's stick to indices. So we can create an index or indices for a lot of different things. So the most popular type of indices that you see people trading is they are stock indices. That is US 30, NAS 100, or NASDAQ, and then you have German 30 and stuff like that. So for example, US 30 is a list of the top 30 technology companies in the US. So the top 30 technology companies, there are certain criteria that they need to meet, and they add all the share prices together, and then they have one index that they call the US 30. And NAS 100 is the top 100 companies also following a specific criteria. And then we have another common one, which is S&P 500. S&P 500, which also looks like another category of companies, mostly small cap companies, a list of 500 companies. So you can create an index from stuff like that. And then we have what we call synthetic indices. So synthetic indices means that it is not, for stock indices, it is based on something real, like the actual stock prices that is moving, that is, we are putting the price together to give us something like US 30, NASDAQ, S&P 500. But for synthetic indices, when we say something is synthetic, it means it is not natural. If it's not natural, it means it is not real. So for synthetic indices, it means whatever is being created is not real. Like we can create a synthetic indices for like anything. So the VIX that we trade is something that is generated from computer algorithm, which means it is not really based on something that is real. Like it can be based on anything at all, right? So anything that, like you see with the stock index, like US 30 and NASDAQ, it's actually measuring the share prices of companies. But with synthetic indices, it can be based on anything at all that is not real, but measuring the movement of something. So if that thing goes in a certain direction, you have the index going up or down. So these are the markets that you can trade. So with Forex, crypto, and then indices or synthetic indices, we trade them with what we call leverage. So I'll explain leverage later. Leverage. So I'm introducing a new terminology. I know some of you are already trading, so you already know this. You can trade them with leverage, which means that you can trade or buy an amount that is more than the amount you have in your account. So it's like the bank giving you loan. And in this case, it's not your bank, it's a broker. So another terminology here is a broker. So we'll look at what a broker is. So these things are traded with leverage given by the broker. It's like loan. But with stocks, you can trade stocks with leverage, just like indices, Forex, and crypto. But you mostly stocks is traded as a spot. So when we say stock is traded as a spot, it means that if, let's say, the shares of Facebook is $300 per share. So if the share price of Facebook is $300 per share, what this means is that if you buy one share of Facebook, it's 300. If it moves from 300 to 350, it means you made $50 profit. Before you can buy this, you need to have the actual amount, $300 in your account before you can buy it. But if you are using leverage, you can be able to buy something even though the money you have is not equal to the price of what you are buying. But when you are losing, you can only lose money up to the actual money in your account. So maybe you can buy something that is worth $5,000. But when you are losing and you have $100 in your account, you can only lose $100 and your account is gone. So leverage can be good and bad. So I will explain this in details when we talk about leverage, right? I'll explain this into detail. So This is just how do you call a short video, just to make you know that we are still in business. And the focus of the class that we are going to do will be on Forex and maybe synthetic indices as well. Those who are interested in crypto and stocks, we might also look at that. But the idea is to be able to analyze the financial market. If you can analyze the market, you can transfer the knowledge from Forex to stocks to crypto to indices, right? Because they are all based off a similar structure, just that the things that influence the movements are just slightly different, right? So these are the markets that we are going to look at, that you can trade, right? Forex, stocks, crypto, and synthetic indices, right? So watch the video and then get back to me with questions if you have any, and then I'm sure by Saturday I should be free. I don't have any schedules on Saturday. So Saturday or Sunday, I'll drop another video. All right. Later.